Good evening. My name is Joseph Cuevas. I will be recording an audiobook today for International Accounting. Edition 6, author Timothy Dupnik, Mark Finn, Giorgio Gotti, and Hector Pereira. My goal for doing this is to provide my classmates with audiobooks that do not sound like robots, and to give me additional motivation to actually read my course materials. So whether you're listening to this in the car, after a lazy day, don't really feel like reading, I got you. Let's get started. Chapter 1. Introduction to International Accounting. Learning Objectives. After reading this chapter, you should be able to discuss the nature and scope of international accounting, describe accounting issues confronted by companies involved in international trade, import and export transactions, explain the reasons for and the accounting issues associated with foreign direct investment. Describe the practice of cross-listing on foreign stock exchanges. Explain the notion of global accounting standards. And finally, understand the importance of international trade, foreign direct investment, and multinational corporations in the global economy. Introduction. Most accounting students are familiar with financial accounting and managerial accounting, but many have only a vague idea of what international accounting is. Defined broadly, the accounting in international accounting encompasses the functional areas of financial reporting, managerial accounting, auditing, and taxation. The word international in international accounting can be defined at 3 different levels. At the first level, international accounting can be viewed as the study of the standards, guidelines, and rules of accounting, auditing, and taxation that exist within each country, as well as comparison of those items across countries. Examples would be cross-country comparisons of rules related to the financial reporting of property, plant, and equipment, income and other taxes, and the requirements for becoming a member of the national accounting profession. At the second level is supranational accounting, which denotes standards, guidelines, and rules of financial reporting, auditing, and taxation issued by supranational organizations. Such organizations include the International Accounting Standards Board, or IASB, the International Federation of Accountants, or IFAC, and the Organization of Economic Cooperation and Development, or OECD. At the third level, the company level, international accounting can be viewed in terms of the accounting standards, guidelines, and practices that a company follows that are specifically related to its international business activities and foreign investments. These would include standards for accounting for transactions denominated in a foreign currency, tax rules related to international transfer pricing, and techniques for evaluating the performance of foreign operations. Clearly, international accounting encompasses an enormous amount of territory, both geographically and topically. It is not feasible or desirable to cover the entire discipline in one course. This book is designed to be used in a course that provides an overview of the broadly defined area of international accounting, including certain supranational guidelines, but that focuses on the accounting issues related to international business activities and foreign investments. In other words, this book focuses on international accounting issues at the company level that are specifically relevant to multinational corporations. The next section of this chapter introduces accounting issues that are important to multinational corporations by describing the evolution of a fictitious company as it becomes increasingly more multinational. To provide justification for the importance of these issues, the following section highlights the importance of international trade, foreign direct investment, and multinational corporations in the global economy. The final section of this chapter summarizes the major topics covered in this book. Evolution of a multinational corporation. To gain an appreciation for the accounting issues related to international business, let us follow the evolution of a Magnum Corporation, a fictional auto parts manufacturer headquartered in Detroit, Michigan. Magnum was founded in the early 1950s to produce and sell rear-view mirrors to automakers in the United States. For the first several decades, all of Magnum's transactions occurred in the United States. Raw materials and machinery and equipment were purchased from suppliers located across the United States. Finished products were sold to U.S. automakers. Loans were obtained from banks in Michigan and Illinois. And the common stock was sold on the New York Stock Exchange. At this stage, all of Magnum's business activities were carried out in U.S. dollars. Its financial reporting was done in compliance with U.S. Generally Accepted Accounting Principles, or GAAP, and taxes were paid to the U.S. federal government and the state of Michigan. Sales to customers. In the 1980s, one of Magnum's major customers, Normal Motors Incorporated, acquired a production facility in the United Kingdom, and Magnum was asked to supply this operation with rear-view mirrors. The most feasible means of supplying Normal Motors UK, NM UK, was to manufacture the mirrors in Michigan and then ship them to the United Kingdom, thus making export sales to a foreign customer. If the sales had been invoiced in US dollars, accounting for the export sales would have been no different from accounting for domestic sales. However, Normal Motors required Magnum to bill the sales to NMUK in British pounds, thus creating foreign currency sales for Magnum. The first shipment of mirrors to NMUK was invoiced at £100,000, with credit terms of 2 to 10, net 30. If Magnum were a British company, the journal entry to record this sale would have been debit accounts receivable, or plus assets, £100,000. Credit sales revenue, or plus equity, £100,000. However, Magnum is a US-based company that keeps its accounting records in US dollars. To account for this export sale, the British pound sales revenue and account receivable must be translated into US dollar. Assuming that the exchange rate between the pound and the US dollar at the time of this transaction was 1 pound equals US dollar 1.35 or $1.35 US dollar, the journal entry would have been debit accounts receivable in pound plus assets, US dollar 135,000. Credit sales revenue plus equity, US dollar 135,000. This was the first time since its formation that Magnum had found it necessary to account for a transaction denominated, or invoiced, in a currency other than the US dollar. The company added to its chart of accounts a new account indicating that the receivable was in a foreign currency, accounts receivable pound, and the accountant had to determine the appropriate exchange rate to translate the pound into US dollar. As luck would have it, by the time NMUK paid its account to Magnum, the value of the pound had fallen to 1 pound equals $1.30 in US dollar. And the 100,000 pounds received by Magnum was converted into 130,000 US dollars. The partial journal entry to record this would have been debit cash or plus assets, US dollar $130,000. Credit accounts receivable in pound minus assets, US dollar 135,000. This journal entry is obviously incomplete because the debit and the credit are not equal and the balance sheet will be out of balance. A question arises. How should the difference of the US dollar 5,000 between the original US dollar value of the receivable and the actual number of US dollar received be reflected in the accounting records? Two possible answers would be: 1. To treat the difference as a reduction in sales revenue, or 2. To record the difference as a separate loss resulting from a change in the foreign exchange rate. This is an accounting issue that Magnum was not required to deal with until it became involved in export sales. Specific rules for accounting for foreign currency transactions exist in the United States, and Magnum's accountants had to develop an ability to apply those rules. Through the British pound account receivable, Magnum became exposed to foreign exchange risk. The risk that the foreign currency will decrease in US dollar value over the life of the receivable. The obvious way to avoid this risk is to require foreign customers to pay for their purchase in US dollar. Sometimes foreign customers will not or cannot pay in the seller's currency, and to make the sale, the seller is obliged to accept the payment in the foreign currency. Thus, foreign exchange risk arises. Hedges of foreign exchange risk. Companies can use a variety of techniques to manage or hedge their exposure to foreign exchange risk. A popular way to hedge foreign exchange risk is through the purchase of a foreign currency option that gives the option owner the right, but not the obligation, to sell foreign currency at a predetermined exchange rate known as the strike price. Magnum purchased such an option for $200 and was able to sell the 100,000 pounds it received for a total of $135,000 because of the option's strike price. The foreign currency option was an asset that Magnum was required to account for its 30-day life. Options are a type of derivative financial instrument, the accounting for which can be quite complicated. Foreign currency forward contracts are another example of derivative financial instruments commonly used to hedge foreign exchange risk. Magnum never had to worry about how to account for hedging instruments such as options and forward contracts until it became involved in international trade. Foreign direct investment. Although the managers at Magnum at first were apprehensive about international business transactions, they soon discovered that foreign sales were a good way to grow revenues and, with careful management of foreign currency risk, would allow the company to earn adequate profit. Over time, Magnum became known throughout Europe for its quality products. The company entered into negotiations and eventually landed supplier contracts with several European automakers, filling orders through export sales from its factory in the United States. Because of the combination of increased shipping costs and its European customers' desire to move toward just-in-time inventory systems, Magnum began thinking about investing in a production facility somewhere in Europe. The ownership and control of foreign assets, such as a manufacturing plant, are known as foreign direct investment. For Magnum, maintaining and increasing sales to European customers, reducing shipping costs, and gaining a foothold in the European Union economic bloc were all relevant reasons for making a foreign direct investment. Two ways for Magnum to establish a manufacturing presence in Europe were to purchase an existing mirror manufacturer, acquisition, or to construct a brand new plant, greenfield investment. In either case, the company needed to calculate the net present value, NPV, of future cash flows from the potential investment to make sure that the return on investment would be adequate. Determination of NPV involves forecasting future profits and cash flows, discounting those cash flows back to their present value and comparing this with the amount of the investment. NPV calculations inherently involve a great deal of uncertainty. This is even more true when the investment is being made in a foreign country. In the early 1990s, Magnum identified a company in Portugal, Espelho Ltda, as a potential acquisition candidate. In determining NPV, Magnum needed to forecast future cash flows and determine a fair price to pay for Espelho. Magnum had to deal with several complications in making a foreign investment decision that would not have come into play in a domestic situation. First, to assist in determining a fair price to offer for the company, Magnum asked for Espelho's financial statements for the past 5 years. The financial statements had been prepared in accordance with Portuguese accounting rules, which were much different from the accounting rules Magnum's managers were familiar with. The balance sheet did not provide a clear picture of the company's assets, and many liabilities appeared to be kept off balance sheet. Footnote disclosure was limited, and cash flow information was not provided. This was the first time that Magnum's management became aware of the significant differences in accounting between countries. Magnum's accountants spent much time and effort restating Espelho's financial statements to a basis that Magnum felt it could use for valuing the company. Second, in determining NPV, cash flows should be measured on an after-tax basis. To adequately incorporate tax effects into the analysis, Magnum's management had to learn a great deal about the Portuguese income tax system and the taxes and restrictions imposed on dividend payments made to foreign parent companies. These and other complications make the analysis of a foreign investment much more challenging than the analysis of a domestic investment. Magnum determined that the purchase of Espelho Ltda would satisfy its European production needs and also generate an adequate return on investment. Magnum acquired all of the company's outstanding common stock. The Espelho Ltda continued as a Portuguese corporation. The investment in a subsidiary located in a foreign country created several new accounting challenges that Magnum previously had not been required to address. Financial reporting for foreign operations. As a publicly traded company in the United States, Magnum Corporation is required to prepare consolidated financial statements in which the assets, liabilities, and income of its subsidiaries, or domestic and foreign, are combined with those of the parent company. The consolidated financial statements must be presented in US dollars and prepared using USGAAP, Espelho Ltda. Being a Portuguese corporation, keeps its accounting records in euros. In accordance with Portuguese GAAP, to consolidate the results of its Portuguese subsidiary, 2 procedures must be completed. First, for all of those accounting issues for which Portuguese accounting rules differ from US GAAP, accounts calculated under Portuguese GAAP must be converted to US GAAP basis. To do this, Magnum needs someone who has expertise in both US and Portuguese GAAP and can reconcile the differences between them. Magnum's financial reporting system was altered to accommodate this conversion process. Magnum relied heavily on its external auditing firm, one of the so-called Big Four firms, in developing procedures to restate Espelho's financial statements to US GAAP. Second, after the account balances have been converted to US GAAP basis, they then must be translated from the foreign currency, euros, into the US dollar. Several methods exist for translating foreign currency financial statements into the parent's reporting currency. All the methods involve the use of both the current exchange rate at the balance sheet data and historical exchange rates. By translating some financial statement items at the current exchange rate and other items at historical exchange rates, The resulting translated balance sheet no longer balances, as can be seen in the following example. Assets: 1,000 euros multiplied by $1.35 USD is equal to US dollar 1,350. Liabilities: 600 times $1.35 equals 810. Stockholders' equity: 400 times 1 equals 400. 1,000 euros US dollar 1,210. To get the US dollar financial statements back into balance, a translation adjustment of 140 US dollars must be added to the stockholders' equity. One of the major debates in translating foreign currency financial statements is whether the translation adjustment should be reported as a gain in consolidated net income or whether it should be treated as a component of other comprehensive income and added to equity with no effect on net income. Each country has rules regarding the appropriate exchange rate to be used for the various financial statement items and the disposition of the translation adjustment. Magnum's accountants needed to learn and be able to apply the rules in force in the United States. International income taxation. The existence of a foreign subsidiary raises two kinds of questions with respect to taxation. 1. What are the income taxes that Espejo Ltda has to pay in the host country, Portugal, and how can those taxes legally be minimized? 2. What are the taxes, if any, that Magnum Corporation has to pay in its home country, the United States, related to the income earned by Espejo Ltda in Portugal, and how can these taxes legally be minimized? All else being equal, Magnum wants to minimize the total amount of taxes it pays worldwide because doing so will maximize its after-tax cash flows. To achieve this objective, Magnum must have expertise in the tax systems in each of the countries in which it operates. Just as every country has its own financial accounting rules, each country also has a unique set of tax regulations. As a Portuguese corporation doing business in Portugal, Espejo Ltda is required to pay income tax to the Portuguese government on its Portuguese source income. Magnum's management began to understand the Portuguese tax system in the process of determining after-tax net present value when deciding to acquire Espejo. At the time Magnum acquired Espejo, the United States taxed corporate profits on a worldwide basis, which meant that Magnum also has to pay tax to the U.S. government on the income earned by its Portuguese subsidiary. However, because Espejo is legally incorporated in Portugal as a subsidiary, U.S. tax was not owed until Espejo's income was repatriated to the parent in the United States as a dividend. If Espejo were registered with the Portuguese government as a branch, its income would be taxed currently in the United States regardless of when the income is remitted to Magnum. Thus, income earned by foreign operations can be subject to double taxation. Some home countries provide parent companies with foreign operations relief from double taxation through a credit for the amount of taxes already paid to the foreign government. Tax treaties between two countries might also provide some relief from double taxation. Other countries eliminate double taxation by exempting income earned by foreign operations from corporate income taxation. Magnum's tax accountants must be very conversant in both U.S. and foreign tax laws as it pertains to foreign income to make sure that the company is not paying more taxes worldwide than necessary. International transfer pricing. Some companies with foreign operations attempt to minimize the amount of worldwide taxes they pay through the use of discretionary transfer pricing. Automobile mirrors consist of three major components: mirrored glass, a plastic housing, and a steel bracket. The injection molding machinery for producing the plastic housing is expensive, and Espejo Ltda does not own such equipment. The plastic parts that Espejo requires are produced by Magnum in the United States and then shipped to Espejo as an intercompany sale. Prices must be established for these intercompany transfers. The transfer price generates sales revenue for Magnum and is a component of cost of goods sold for Espejo. If the transfer were being made within the United States, Magnum's management would allow the buyer and the seller to negotiate a price that both would be willing to accept. This intercompany sale is being made from one country to another. Because the income tax rate in Portugal is higher than that in the United States, Magnum requires these parts to be sold to Espejo at as high a price as possible. Transferring parts to Portugal at high prices shifts a gross profit to the United States that otherwise would be earned in Portugal, thus reducing the total taxes paid across both countries. Most governments are aware that multinational companies have the ability to shift profits from high-tax countries to low-tax countries through discretionary transfer pricing. To make sure that companies pay their fair share of local taxes, most countries have laws that regulate international transfer pricing. Magnum Corporation must be careful that, in transferring parts from the United States to Portugal, the transfer price is acceptable to tax authorities in both countries. The United States and several other countries have become aggressive in enforcing their transfer pricing regulations. Performance evaluation of foreign operations. To ensure that operations in both the United States and Portugal are achieving their objectives, Magnum's top management requests that the managers of the various operating units submit periodic reports to headquarters detailing their unit's performance. Headquarters management is interested in evaluating the performance of the operating unit as well as the performance of the individuals responsible for managing those units. The process for evaluating performance that Magnum has used in the past for its U.S. operations is not directly transferable to evaluating the performance of Espejo Ltda. Several issues unique to foreign operations must be considered in designing the evaluation system. For example, Magnum has to decide whether to evaluate Espejo's performance on the basis of euros or US dollars. Translation from one currency to another can affect return on investment ratios that are often used as performance measures. Magnum also must decide whether reported results should be adjusted to factor out those items over which Espejo's managers have no control, such as the artificially high price paid for plastic parts imported from Magnum. There are no universally correct solutions to the various issues that Magnum must address in evaluating performance, and the company is likely to find it necessary to make periodic adjustments to its evaluation process for foreign operations. International auditing. The primary objective of Magnum's performance evaluation system is to maintain control over its decentralized operations. Another important component of the management control process is internal auditing. The internal auditor must 1. Make sure that the company's policies and procedures are being followed, and 2. Uncover errors, inefficiencies, and, unfortunately at times, fraud. There are several issues that make the internal audit of a foreign operation more complicated than domestic audits. Perhaps the most obvious obstacle to performing an effective internal audit is language. To be able to communicate with Espejo's managers and employees, asking the questions that need to be asked and understanding the answers, Magnum's internal auditors should speak Portuguese. The auditors also need to be familiar with the local culture and customs, because these may affect the amount of work necessary in the audit. This familiarity can help to explain some of the behavior encountered and perhaps can be useful in planning the audit. Another important function of the internal auditor is to make sure that the company is in compliance with the Foreign Corrupt Practices Act, which prohibits a U.S. company from paying bribes to foreign government officials to obtain business. Magnum needs to make sure that the internal controls are in place to provide reasonable assurance that illegal payments are not made. External auditors encountered the same problems as internal auditors in dealing with the foreign operations of their clients. External auditors with multinational company clients must have expertise in the various sets of financial accounting rules as well as the auditing standards in the various jurisdictions in which their clients operate. Magnum's external auditors, for example, must be capable of applying Portuguese auditing standards to attest that Espejo's financial statements present a true and fair view in accordance with Portuguese GAAP. In addition, they must apply U.S. auditing standards to verify that the reconciliation of Espejo's financial statements for consolidation purposes brings the financial statements into compliance with U.S. GAAP. As firms have become more multinational, so have their external auditors. Today, the Big Four international accounting firms are among the most multinational organizations in the world. Indeed, one of the Big Four accounting firms, KPMG, is the result of a merger of accounting firms that originated in 4 different countries: Germany, Netherlands, United Kingdom, and United States. Each of the Big Four firms, Deloitte Touche Tohmatsu, Ernst & Young, KPMG, and PricewaterhouseCoopers, has offices in more than 120 countries and territories around the world. Cross-listing on foreign stock exchanges. Magnum's investment in Portugal turned out to be extremely profitable, and over time the company established operations in the countries around the world. As each new country was added to their increasingly international company, Magnum had to address new problems associated with foreign GAAP conversion, foreign currency translation, international taxation and transfer pricing, and management control. By the beginning of the 21st century, Magnum had become a truly global enterprise, with more than 10,000 employees spread across 16 different countries. Although the United States remained its major target market, the company generated less than half of its revenue in its home country. Magnum eventually decided that in addition to its stock being listed on the New York Stock Exchange, NYSE, there would be advantages to having the stock listed and traded on several foreign stock exchanges. Most stock exchanges require companies to file an annual report and specify the accounting rules that must be followed in preparing financial statements. Regulations pertaining to foreign companies can differ from those for domestic companies. For example, in the United States, the Securities and Exchange Commission, SEC, requires all U.S. companies to use U.S. GAAP in preparing their financial statements. Foreign companies listed on U.S. stock exchanges may use foreign GAAP in preparing their financial statements, but generally must provide a reconciliation of net income and stockholders' equity to U.S. GAAP. In 2007, the U.S. SEC relaxed this requirement for those foreign companies that use International Financial Reporting Standards, IFRS, developed by the International Accounting Standards Board, IASB, to prepare financial statements. Foreign companies that file financial statements with the SEC that have been prepared under IFRS need not provide any reconciliation to US GAAP. Many stock exchanges around the world allow foreign companies to be listed on those exchanges by using IFRS in preparing their financial statements. Magnum determined that by preparing a set of consolidated financial statements based on IFRS, it could gain access to most of the stock exchanges it might possibly want to, including London's and Hong Kong's. With the help of its external auditing firm, Magnum's accountants developed a second set of financial statements prepared in accordance with IFRS, and the company was able to obtain stock exchange listings in several foreign countries. Sustainability reporting. As Magnum's managers became more internationally oriented, they discovered that several automotive firms located in foreign countries provide information on their corporate websites related to sustainability. In addition to an annual financial report containing traditional financial statements, many companies today prepare a separate report that provides the company's stakeholders with information on the company's sustainability strategy and the progress made in meeting sustainability objectives. Although companies give those reports various names such as Environmental, Social and Governance, ESG report, or Corporate Responsibility report, commonly they are simply titled Sustainability Report. Sustainability reports tend to provide information on issues such as environmental impact, labor practices, product safety, and corporate governance. In many cases, companies prepare and publish these reports voluntarily, but sustainability disclosures are actually required in several countries. Seeing a potential benefit to providing stakeholders with this type of information, Magnum's management team developed a framework for a corporate responsibility and sustainability report and began to voluntarily provide this information on the company's website. Global Financial Reporting Standards. Through their experiences in analyzing the financial statements of potential acquisitions and in cross-listings of the company's stock, Magnum's managers began to wonder whether the differences that exist in GAAP across countries were really necessary. There would be significant advantages if all countries, including the United States, were to adopt a common set of financial reporting standards. In that case, Magnum could use one set of standards as the local GAAP in each of the countries in which it has operations and thus avoid the GAAP conversion that it currently must perform in preparing consolidated financial statements. It also could use one set of financial statements to facilitate obtaining financing in different countries. In addition, a single set of financial reporting standards used worldwide would significantly reduce the problems that the company had experienced over the years in evaluating foreign investment opportunities based on financial statements prepared in compliance with a variety of local GAAP. Over time, Magnum Corporation became a strong proponent of global financial reporting standards. The global economy. Although Magnum is a fictitious company, its evolution into a multinational corporation is not unrealistic. Most companies begin by selling their products in the domestic market. As foreign demand for the company's product arises, this demand is met initially through making export sales. Exporting is the entry point for most companies into the world of international business. International trade. International trade, imports and exports, constitutes a significant portion of the world economy. In 2020, companies worldwide exported more than $17.5 trillion worth of merchandise. The three largest exporters were China, the United States, and Germany, in that order. The United States, China, and Germany, in that order, were the three largest importers. Although the international trade has existed for thousands of years, recent growth in trade has been phenomenal over the period of 2009 to 2019. U.S. exports increased from $1,056 billion to $1,645 billion per year, a 56% increase. During the same period, Chinese exports more than doubled to 2,499 billion in 2019. The number of companies involved in international trade also has grown substantially. The number of U.S. companies making export sales rose by 233% from 1987 to 1999, when the number stood at 231,420. In 2019, 288,063 U.S. companies were involved in exporting. The Boeing Company is a U.S.-based aerospace company with billions of dollars of annual export sales. In 2020, 37%, 22 billion, of the company's sales were outside of the United States. In addition, some of the company's key suppliers and subcontractors are located in Europe and Japan. However, not only large companies are involved in exporting. Companies with fewer than 20 employees comprise more than 35% of U.S. exporters. Foreign direct investment. The product cycle theory suggests that, as time passes, exporters might believe the only way to retain their advantage over competition in foreign markets is to produce locally, thereby reducing transportation costs. Companies often acquire existing operations in foreign countries as a way to establish a local production capability. Alternatively, companies can establish a local presence by founding a new company specifically tailored to the company's needs. Sometimes this is done through a joint venture with a local partner. The acquisition of existing foreign companies and the creation of new foreign subsidiaries are the two most common forms of what is known as foreign direct investment, FDI. Each year, in its World Investment Report, the United Nations publishes data on cross-border M&A, acquisition of existing foreign companies, and greenfield FDI, creation of new foreign subsidiaries, activity. In 2020, 6,201 cross-border M&A transactions took place, with a total of $475 billion invested. U.S. companies were most often the buyers in these transactions, 17.4% of the total, followed by UK companies, 8.9%. US and UK companies also were the most common sellers in these transactions. In 2020, 12,971 greenfield FDI projects were announced, with a total investment of $564 billion. Europe was the most popular region for new investment, 31.3% of the total, followed by Asia, 30.1%. The single most popular country for greenfield FDI was the United States, 11.8%, with the United Kingdom, China, Germany, and Poland rounding out the top 5 countries. By far, information and communication was the most popular industry for greenfield FDI, 22.4% of the total. The cumulative amount of FDI worldwide was increased substantially over the past several decades. The total stock of FDI was $2.2 trillion in 1990. By 2010, cumulative FDI had increased almost tenfold to $19.9 trillion. And by 2020, it had grown to $41.4 trillion. The United States has received more FDI than any other country, 10.8 trillion, followed by the Netherlands, 2.9 trillion, the United Kingdom, 2.2 trillion, China, 1.9 trillion, and Hong Kong, 1.9 trillion. The United States also has the largest amount of cumulative outbound FDI, 8.1 trillion, followed by the Netherlands, 3.8 trillion, China, 2.4 trillion, and the United Kingdom, 2.1 trillion, and Japan, 2 trillion. Multinational corporations. A multinational corporation is a company that is headquartered in one country but has operations in other countries. In 2009, the United Nations estimated that there were more than 82,000 multinational companies in the world, with more than 810,000 foreign affiliates. At that time, the 100 largest multinational companies accounted for approximately 4% of the world's GDP. Companies located in a relatively small number of countries conduct a large proportion of international trade and investment. These countries include the Triad: the United States, Japan, and Western Europe, that collectively dominated the world economy until the 1990s. More recently, Chinese companies have emerged as major players in the world economy. As Exhibit 1.1 shows, the Triad countries plus China are home to the vast majority of the 100 largest companies in the world. In 2016, 19 of the world's 100 largest companies were Chinese. By 2021, that number had increased to 30, and is second only to the United States. Exhibit 1.1, home country of largest 100 companies by revenues. United States, 36. Japan, 9. Western Europe, including Germany, France, Netherlands, Switzerland, United Kingdom, and Italy. Germany, 6. France, 5. Netherlands, 3. Switzerland, 2. United Kingdom, 2. Italy, 1. China, 9. What? China, 30. Other countries: South Korea, India, Russia, Saudi Arabia, Taiwan. South Korea, 2. India, 1. Russia, 1. Saudi Arabia, 1. Taiwan, 1. In 2020, the United Nations measured the multinationality of companies by averaging 3 factors: the ratio of foreign sales to total sales, the ratio of foreign assets to total assets, and the ratio of foreign employees to total employees. Exhibit 1.2 lists the top 10 non-financial companies according to this multinational index, MNI. Barrick Gold Corporation was the most multinational company in the world, with more than 98% of its assets, sales, and employees located outside its home country of Canada. Medtronic plc is headquartered in Dublin, Ireland, but generates less than 3% of its revenue from operations in its home country. 6 of the 10 companies on this list are headquartered in Western Europe. The 5 most multinational U.S. companies in 2020, in order, were Mondelez International, Coca-Cola, Johnson & Johnson, Chevron, and IBM. Mondelez had a multinationality index of 75.9%. Many companies have established a worldwide presence. As one example, US-based Nike, Inc., Incorporated, the world's largest manufacturer of athletic footwear, apparel, and equipment, has branch offices and subsidiaries in 51 countries, sells products in virtually all countries, and has more than 70,000 employees around the globe. Almost all of Nike's footwear and apparel products are manufactured outside of its home country of the United States. The company generates approximately 59% of its sales outside of North America. As another example, Unilever plc is a diversified company headquartered in the United Kingdom. The company operates in more than 190 countries around the world and has significant subsidiaries in countries like Argentina, Australia, Brazil, India, the Netherlands, Switzerland, and the United States, among others. Unilever uses the euro as its reporting currency in presenting financial statements. Because many of its subsidiaries are located outside of the Eurozone, Unilever must translate the financial statements from these operations into euros for consolidation purposes. Unilever's management notes that it uses foreign currency borrowings and forward contracts as hedges of the currency risk associated with net investments in foreign subsidiaries. Internal capital markets. Many multinational corporations have found it necessary, for one reason or another, to have their stock cross-listed on foreign stock exchanges. In addition to its stock being listed on the stock exchange in London, Unilever's shares also are listed on the Euronext Amsterdam Exchange in the Netherlands and the New York Stock Exchange, NYSE. In the United States, large companies in small countries, such as Finland's Nokia Oy, might find cross-listing their stock necessary to obtain sufficient capital at a reasonable cost. Nokia shares are listed on stock exchanges in Helsinki, Paris, and New York. Other companies obtain a listing on a foreign exchange to have an acquisition currency for acquiring firms in the country through stock swaps. Several years after obtaining an NYSE listing in 1993, Germany's Daimler-Benz acquired Chrysler in the United States through an exchange of shares. The resulting Daimler-Chrysler merger was short-lived, however, with Daimler selling its investment in Chrysler in 2007. As of May 31st, 2021, there were 494 foreign companies from 45 countries cross-listed on the NYSE. More than one quarter of these companies are Canadian. Likewise, a number of U.S. companies are cross-listed on non-U.S. stock exchanges. For example, approximately 20 U.S. companies are listed on the London Stock Exchange, including Boeing, Honeywell, and Marsh & McLennan. U.S. companies such as Aerocom, Caterpillar, and GT Biopharma are listed on the Euronext Paris Stock Exchange. Outline of the book. The evolution of the fictitious Magnum Corporation presented in this chapter highlights many of the major accounting issues that a multinational corporation must address and that form the focus for this book. The remainder of this book is organized as follows. Chapter 2 and 3 focus on differences in financial reporting across countries and the worldwide convergence of financial reporting standards. Chapter 2 provides evidence of the diversity in financial reporting that has existed internationally, explores the reasons for that diversity, and describes the various attempts to classify countries by accounting system. Chapter 3 describes and evaluates the major efforts to converge accounting internationally. The most important player in the development of global financial reporting standards is the International Accounting Standards Board, IASB. Chapter 3 describes the work of the IASB and introduces International Financial Reporting Standards, IFRS. Chapters 4 and 5 describe and demonstrate the requirements of selected IASB standards through numerical examples. In addition to describing the guidance provided by IFRS, these chapters provide comparisons with US GAAP to indicate the differences and similarities between the two sets of standards. Chapter 4 focuses on IFRS related to the recognition and measurement of assets, specifically inventories, property, plant, and equipment, investment property, biological assets, and intangible and goodwill. This chapter also covers business combinations and consolidated financial statements and borrowing costs. Chapter 5 covers IFRS related to current liabilities, provisions, employee benefits, share-based payment, income taxes, revenue, financial statements, and leases. IFRS that deal exclusively with disclosure and presentation issues are also briefly summarized. Chapters 6 and 7 focus on financial reporting issues that are of particular relevance to international business operations, international trade, and foreign direct investments. Chapter 6 covers the accounting for international transactions that are denominated in a foreign currency transactions, as well as the accounting for hedges used to minimize the risk associated with these transactions arising from changes in exchange rates. Hedges of foreign exchange risk. Chapter 7 demonstrates the translation of foreign currency financial statements of foreign operations for the purpose of preparing consolidated financial statements. An appendix to Chapter 7 covers the translation of financial statements when the foreign operation is located in a hyperinflationary country. Chapter 6 and 7 focus on IFRS and US GAAP related to these topics. Chapter 8 and 9 cover the topics of international taxation and international transfer pricing. Chapter 8 provides an overview of corporate income taxation worldwide and the focuses on the taxation of foreign operation income by the home country government. A working knowledge of international taxation issues is important for all students of international business and accounting, not only for tax specialists. Chapter 9 covers the topic of international transfer pricing, focusing on tax implications. This chapter describes rules established by national governments to contract multinational corporations' use of international transfer pricing to reduce income taxes, with an emphasis on the rules imposed by the U.S. government. These rules are relevant not only for U.S. multinational corporations, but also for foreign corporations that have subsidiaries in the United States. Chapter 10 focuses on managerial accounting issues of particular relevance to multinational corporations. This chapter covers multinational capital budgeting as a vital component of strategy formulation and operational budgeting as a key ingredient in strategy implementation. Chapter 10 also describes issues that must be addressed in designing a process for evaluating the performance of foreign operations. Chapter 11 covers auditing and corporate governance from an international perspective. This chapter discusses both external and internal auditing issues as they relate to corporate governance in an international context. Chapter 11 also describes international diversity in external auditing, international standards on auditing, and the international harmonization of auditing standards. Chapter 12 introduces sustainability reporting, a system of measuring and disclosing an entity's social and environmental performance using well-defined internationally agreed-upon standards. Sustainability reporting is now required of all large companies in the European Union. Elsewhere, most large companies voluntarily publish annual sustainability reports that are analogous to traditional annual financial reports. Chapter 12 describes the structure of the sustainability reporting system, including the work of the Global Reporting Initiative at the international level and the Sustainability Accounting Standards Board in the United States. Chapter Summary 1. International accounting is an extremely broad topic. At a minimum, it focuses on the accounting issues unique to multinational corporations. At the other extreme, it includes the study of the various functional areas of accounting, financial, managerial, auditing, and taxation in all countries of the world, as well as a comparison across countries. This book focuses on the accounting issues encountered by multinational companies engaged in international trade and making foreign direct investments, and also includes coverage of certain supranational guidelines that are relevant for multinationals. 2. The world economy is becoming increasingly more integrated. International trade, imports, and exports has grown substantially in recent years and has even become a normal part of business for relatively small companies. 3. The acquisition of an existing foreign company or the creation of a new foreign subsidiary are the two most common forms of foreign direct investment, FDI. The cumulative amount of FDI has increased substantially in recent decades. The United States has attracted more FDI than any other country. 4. There are tens of thousands of multinational companies in the world. A disproportionate number of the largest multinational corporations are headquartered in the United States, China, Japan, and Western Europe. According to the United Nations, 7 of the top 10 most multinational non-financial companies in the world in 2019 were headquartered in Europe, with 4 of these companies located in the United Kingdom. 6. In addition to establishing operations overseas, some multinational companies also cross-list their shares on stock exchanges outside of their home country. There are a number of reasons for doing this, including gaining access to a larger pool of capital. 7. The remainder of this book consists of 11 chapters. 6 chapters, chapters 2 to 7, deal primarily with financial accounting and reporting issues. Chapters 8 and 9 focus on international taxation and transfer pricing. Chapter 10 deals with management accounting issues specifically relevant to multinational corporations. Chapter 11 provides an international perspective on auditing and corporate governance. The final chapter, Chapter 12, provides an introduction to sustainability reporting at the international level. Questions. Number 1. How important is international trade, imports and exports to the world economy? Number 2. What accounting issues arise for a company as a result of engaging in international trade, imports, and exports? 3. What financial reporting issues arise for a company as a result of making a foreign direct investment? 4. What taxation issues arise for a company as a result of making a foreign direct investment? 5. What are some of the issues that arise in evaluating and maintaining control over foreign operations? 6. Why might a company want its stock listed on a stock exchange outside of its home country? Number 7. Where might one find information that could be used to measure the multinationality of a company? Number 8. What would be the advantages of having a single set of financial reporting standards used worldwide? And that about does it for this chapter. It's been my absolute pleasure reading it for you guys, whoever's listening. And I finished it just in time for the sweet, sweet effects of my nighttime Theraflu to lose its sweet, sweet effects. So, that's good. I just had a coughing fit right now. I paused the audio. I paused the recording. I don't know if any of my coughs or any of my braceful breaths before coughing were captured on recording. And if it was, I would like to apologize. But before I start coughing again, appreciate you guys listening. Give me feedback. I want to get better at reading and, my understandability, I guess. I plan to do this for every chapter. It forces me to read, and I enjoy doing it. So yeah. If anybody has any notes to give me, that would be great, because I suck at taking notes. Have a beautiful morning, evening, nighttime, whenever you're listening to this. Peace.